What is the most common misconception you hear, and what's the truth?
The wealthy have the advisors that know all these strategies that the average person doesn't, so they're doing things different. And so why I say that is with infinite banking, we believe 5 to 10% of the population can qualify to do this. It's a privilege to be able to do infinite banking, in my opinion. It's not too good to be true because it's not for everybody. Not everybody can do it.
What's going on, everybody? Welcome back to Wealth Webinar. Today, we had to do this. We are literally doing what's called a pile-on. We're doing a mentor pile-on in respect and in honor of the late Hulk Hogan. That's right. If any of you are old enough to remember Hulk Hogan from back in your childhood days the way I do, Hulk was my hero. I didn't miss a WrestleMania. So today, what we're going to do is we're going to talk about what you ought to know. Shauna came up with this idea for today's webinar, and I love it. She said, you know, we're always having all this backroom discussion with the mentors, you know, and we're going back and forth with war stories and what clients are doing and the crazy things clients are doing and the things clients aren't doing. And, you know, we're always talking about that, but then we come on here and we're all serious and we're just doing that. So today we're literally going to do a pile-on. We're going to deliver some impactful insight on some of the biggest mindset and strategy blocks, the roadblocks that our clients are going through, the problems that they're having. I just was on the call, oh gosh, I don't know, half hour ago with Craig, and we were talking about some other things. And we're going to literally just go through that. We're going to talk about everything our clients are doing and saying as it relates to money, the infinite banking concepts, as well as how velocity plays into this. So, you know, we're going to do 3 rounds here. So this is a 3-round match. And let's just go over some house rules. So, you know, I always like letting people know what you're going to learn today. We're going to break down a concept that I learned about a long time ago. It's a banking concept. I want to be very clear about that. What we literally teach every day is how to take back the banking functions in your life. So it's very simple. We reverse engineer what the banks do every single day and how the banks are winning and you're not. And we're going to put that power, we're going to take back that control and put it back to you. Simply put, take back the banking functions in your life. This is commonly called the infinite banking concepts. It was pioneered by the late Arn Nelson Nash. He's not the inventor of this. He's just the guy that brought it to us. He brought it to the middle class. He brought it to the masses. Prior to this, it was always referred to as private banking. Private banking systems, private family banking. When you go back to the Rothschilds, the Rockefellers, the Morgans, and the Stanleys, and all the greats throughout time, all of those wealthy families used this, but it was just considered privatized banking. In other words, we are creating a banking system, but it's going to be completely private. It's not going to be known by the public. No one's going to know how much money we have, and no one's going to control it but us and our family. That's it. So that's what we're going to talk about. We're going to literally go deep into that. We're going to do it a little differently today. We're going to do it from the front row. We're going to do it Hulk Hogan style with a pile-on. We got all the mentors on here today, and they're going to literally talk about what they see front line. So if any of you are like, oh my God, I just did a call with Jason and I told him things, I hope he doesn't say that. Don't worry. We're not going to use any clients' names. We're not going to throw anyone under the bus, so you don't need to worry about that. We're just literally going to bring what you are all saying, the concerns you're all having, the problems some of you are having, and we're going to just talk about them. Last week, we did something that I love doing. We talked about the 6 laws of wealth. And we did the 6 laws of wealth, but how we did it was we paralleled that with Earl Nightingale and some of his teachings and some of the things that he talks about in his 7 principles, okay? So there's the 7 rules of gold, which is the richest man in Babylon. I then took that book and I turned it into the 6 laws of wealth as it pertains to modern day times. And then Earl Nightingale obviously was, you know, from an earlier gen. He talked about the 7 principles. So that's what we did last week. It was very well received. People said they really enjoyed it. It was super high energy. And we're going to kind of push on that a little bit. But we're going to talk today about the mistakes, the light bulb moments, the beliefs that our clients have. Our clients, meaning most of you. Now, some of you are not clients of ours, and that's perfectly fine. This webinar, we do it every week, every single week. Without a doubt, without rain, snow, blizzard, we do this show, and we have for years. We don't charge a thing. Matter of fact, we actually give you books to be here. So make sure you tell your friends about this, let them know about this. But let me introduce our mentors and give some quick shout outs. So let's see, who do we got on here? I believe we got, is Mike Samet on here? I'm going to go gallery style here. We got, if Mike's not here, he is going to be because he's on the list. We got Mr. Brian Fouts. Say hello, Brian.
Everybody, Brian Fouts here.
All right. We got Joe Kovacevic, or we call him HELOC Joe.
Hi, everybody.
We got Mr. Sipple, Jason Sipple in the house.
Hello, hello, hello.
We got Craig Yenny. We call him Mr. Spreadsheet, or as some people say, he's good in the sheets. That is the Excel sheets.
Good afternoon.
I've said that a couple times today myself about Craig, so you know.
And then you got Mr. Snaggy.
It's his first time on the show.
Either frozen, and that is a pretty. How many of you think he's frozen, or just think that he's playing a game and actually not moving? What do you think?
Very hard.
Oh, frozen.
Oh.
All right. All right. Okay. So how we're going to do this, we're going to go 3 rounds, folks. And before we get into the 3 rounds, I'm actually going to do a bonus round. Okay. This is kind of where, the announcer comes out and WWE or whatever wrestling match you're at, and they kind of do the announcements. So I'm going to hit some of the questions that are up right now, and we're just going to do this rapid style. So all you mentors, you could just blurt this out, whatever you want to say. So Teresa says, my understanding is that we should use our company's 401k if they do a match, up to the percentage that they match. I have an option to do a traditional 401k, a Roth 401k, or a self-directed. Currently, I chose the Roth 401k, but I would like some feedback, please. So have on at it, guys.
Ooh, this question came up yesterday on the Take Back Control Tuesday. And first off, this is not financial advice. But it's a personal choice, to be honest. It's a personal choice as to where you want to put your money. For me personally, I used to have a 401k. I didn't do the match eventually. I did the 10% or whatever it was. Then I went down to the match, which was 4%. Then eventually I said, why am I doing this? And I went all in on other strategies. But I mean, for me personally, I don't do the match when I had the 401k, but I have a lot of clients that are doing the match because they view it as free money. So.
Wow. Was anyone else got anything?
I would echo what Brian just said. I stopped doing 401ks 16, 17 years ago. Just it wasn't for me. And I know that's part of some people's strategy, but what I started thinking about is access and control. How much am I going to have in terms of access and control of that money? Are taxes going up? Why am I putting money in a system where I'm going to pay taxes on a higher number later? So the whole thing just didn't smell right to me. And I just decided it wasn't something for me. It's not to say it's not something for you, but the other thing I would say is, Brian, you did a WTF a while back when Chris was out. I think Andy Tanner was his name. Your book called 401 Chaos.
Yes.
I'd recommend just everyone just get educated, read it. It's a great book. Just learn more about what's really going on behind the scenes. But the last thing I will mention is we're taught to do the accumulation model. Accumulate, 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 accumulate. But we might build this big net worth in a 401k. You can't take that to go buy bread at the grocery store. But if we build cash flow, we can. So that's the shift I made, just like Brian's talking about years ago, shifted to cash flow versus accumulation.
Yeah. And also too, I'm just going to give my 2 cents. And as we go through this and all the mentors kind of comment, just know that we're not giving financial advice. All of you, when you came into this webinar, you clicked a little disclaimer stating that we're not giving investment advice. Your situations are going to be different. We don't give legal or tax advice either. So just wanted to kind of preface that we're just telling you our opinions on things, but make sure you consult with your professionals. In about a week or so, you'll be able to consult with our RIA, our registered investment advisor, and all of our investment professionals here, because we will soon be able to give you investment advice through our RIA, but that's coming soon. So Teresa, I'll just give you my final wrap up. I love your comment here and your question. The Roth, that's a personal preference, but I think it was a really smart move, especially if you've got a long time horizon, because you're going to have all that money and all the accumulation tax free. So I think that's what I would have done. I would have chosen the Roth. And I am of the sense, unlike some of the others, I think you should put in up to the match, because it truly is free money. I know there's a vesting schedule, so make sure you understand How long is that vesting schedule? How long do you have to stay at that company before all that match is actually your money? Because how a vesting schedule will work, and they're all different, is, you know, you might have to be there for 6 years to get 100% of the money they give you in the match. It's a retention tool, and listen, one that most businesses use. But I think you're doing the right thing. And then let's do Lynettes here. I must be doing my plan incorrectly every month. I put money back into my insurance to save for things I need to pay for at the end of the year, thinking it is bringing down my balance as well and my interest payment, but I just received my interest bill and it was way more than I have money to pay. I couldn't pay one of them already this year, so I have to figure out how to pay this one. I don't want this one to add on to my total, but I am totally doing something wrong. And at the end of the year, when I take out the money I am saving in the policy, that is going to add to my policy loans. So maybe that's not a good place to save that money. I have a meeting soon, so I may not be on here when this gets answered. So Lynette, if you're still on here, it's interesting. Craig, you got to start this one off, because we literally just talked about this, and I almost feel like this is round one. You know, what is one thing that people misunderstand about IBC? So actually, Lynette, well, yeah, let's just get this one out of the way. Craig, what are your thoughts here?
Well, and it is a theme that we're hearing more and more of people thinking they don't. And Lynette, I'm not saying this is what you're doing, but a lot of people will say, just fund your premiums, don't pay the policies, don't pay the policy loans, don't pay the principal back, don't pay the interest. And there are some people out there doing that, but they're not being an honest banker. And that's not what we're teaching. We want you to pay at a bare minimum the loan interest. But I guess for you, Lynette, when you're paying that back, are you paying back premium? Are you putting all that extra into premiums? Are you making loan repayments? Because if you're making loan repayments, that's actually going to reduce your principal throughout the year, which should reduce your interest cost. And we've done the math. We've done the math many, many times where it makes more sense just to pay the principal down, let the interest roll on to the principal in the following year. But that's an easy equation we can look at, but we would need to understand a little bit more about how your money's flowing. But the question is, are you putting that money back into the loan repayment? Or are you putting it all back into premium? What's your money situation look like?
I think for anybody, Craig, it's awesome. For anyone listening, that's, you know, what Lynettes Experience is pretty normal, right? Because you become the banker. Now you got this new thing where you're getting support and you're figuring out how to do it. So, you know, even if everything Craig just said, Lynette, if you pay the interest, if you don't pay the interest, if you pay yourself back, yes, everything Craig said of it being more efficient, paying less interest is true. But at the same time, you have the choices and you're in control of how you're doing it. And it's your system. And so if you don't know it, just know you don't know it yet. So when you have that meeting, or when you have the meeting with your implementation specialist or one of us, we can help get you on track with that.
Yeah, and when I read this question, I was trying to understand, how is she using the policy loans? That would be my number one question, is how are the loans being utilized, you know, in your life right now? Because I don't see that being disclosed in this question. I really don't understand how the loans are being used.
Yeah, I think those are all great things that we have to figure out. But Lynette, I think one of the most important things is getting on a call, getting back to the fundamentals of being your own bank, because being your own bank isn't just changing where the money goes. It's changing where the money goes, which is to the policy, but then adding one step, and that is how the money flows. So you got to follow the process. And to me, just reading it twice now, it sounds like you're taking loans and you're just using the money and then expecting your bank to continue to grow, which it will, but it'll grow very slowly, because the name of the game is, I mean, I don't know a single bank that operates that way, that just gives people loans that never expect. No bank will give you a loan and then not expect you to make a repayment of that loan in some way, shape, or form, and a repayment with interest. So when you're running your own banking system, just like a bank, you need to mimic what a bank does. So when you take a loan, that money needs to go somewhere where it can earn or allow you to recapture a higher percentage than what your cost of capital is. So hypothetically than that, if you took a loan from the policy and it costs 5%, okay, when you take the money out, the insurance company is advancing you money from their general account, essentially giving you part of your death benefit while you're living, up to the amount of cash value you have. So let's say you took a loan for $1,000 and you had $2,000 in cash value. you never ever lost any interest earning ability of that $2,000 because the $1,000 that you received in the loan was the insurance company's money, not yours. Your money's still safe in the policy, earning interest. However, the insurance company for this right charges you simple interest. That's the loan interest. So let's just call it 5%. The name in the rule is when you take the loan, that money has to go out and earn more than 5% somehow, some way. You know, we talk about car loans and we talk about real estate and we talk about investments and we talk about the one that everybody starts with, paying off debt. Because if you've got debt, chances are you're paying more than 5% on your debt. So if we took $1,000 from the policy at 5 and we paid off a credit card for $1,000 that was at 20, you just made a spread of 15 plus you're still earning interest and dividends on the cash value. But this is where I think people go off the rails. And Craig, we talked about this a little bit ago. People stop there. They're like, oh, great. I'm making a spread of 15. It cost me 5. I paid off a credit card at 15, or sorry, at 20, and I made 15%. You didn't make anything yet. You got to understand, you have not realized any spread because you haven't finished. What you now have to do is take the money you used to pay to that credit card that you just paid off. Let's call it $50. I don't know, whatever your payment was. You take the $50 and you set up a repayment back to your bank, i.e. the policy, a loan repayment. We call it recapture the money. Now, once the money goes into the policy, you have now realized the spread because now the money's in your account. It's fully available. You have $50 that you just repaid, plus you have $2,000 that earn interest and dividends. You made money twice, depending on what year you're at in the policy, but effectively, in time, you will have made money twice on that transaction. But you can't just take loans from the policies and just go blow it and spend it on lifestyle and spend it on vacations and not recapture any money. You're stealing from your bank, and eventually that isn't going to be a good thing. So great question, Lynette. The call will be very, very useful. And I've got, unfortunately, 1,200 and some videos on there where we kind of go through that process. So pick and choose which video you want to watch on YouTube, and that'll help. All right, so I got to get into this. Go ahead.
Chris, just real quick, Shauna did post the video that we did, I don't know, probably a month ago on how loans work. So I would encourage anyone that's kind of wrestling through how loans should work with infinite banking, watch that video because we go through the math of it. We show the economic benefit of paying back loans. Check that out. And then, of course, jump on a call with any of the mentors that we have here to kind of dig into it in more detail.
All right. And then I'm going to finish with this one, and then we're going to get into round number 1. Herminio said, can you buy PUAs after you fulfill the max 7 pay rule?
Yes.
That's it. Simple answer. Yes, you can. Just make sure you consult with us, give us a call, or give the insurance company a call and ask them, how much can I put in that keeps me under the MEC 7 pay rule? That's it. All right, let's dive in. Round number 1. And how we're going to do this, folks, very simply, I'm going to ask a question, and then every one of the mentors is going to comment, and we're going to learn a ton here. I guarantee it. So the very first thing I'm going to ask, and this is the title, is the one thing people misunderstand about IBC. What's the most common or costly misconception that all of you hear that's the truth? Okay, so what is the most common misconception you hear, and what's the truth?
The most common misconception, I mean, there's a lot of them. One is, I have to be wealthy to do this. I have to be able to put $100,000 in immediately or I can't do this. And so why is that not true? Well, I can answer it.
It's a great question. It comes up a lot. And the reason why I think that's a misconception is because the wealthy have the advisors that know all these strategies that the average person doesn't. So they're doing things different. Well, guess what? You can do things different as well. You just got to have the right knowledge. So that's the big gap right there. Wealthy people have a different set of knowledge that they're following than the average person. So guess what? That's why we're here. You're now getting that knowledge on this presentation and by being around our campfire. And once you have that different set of knowledge, you can do things differently. You can do things that the wealthy are doing. So, and I actually, by the way, I learned this infinite banking from one of Robert Kiyosaki's advisors. They are in a different group, a different level. And so he was my mentor on this. But guys like Robert Kiyosaki, that's who they're talking to, is those kind of individuals. So that's why I would say why people think the wealthy do it is just because of a different set of knowledge.
Yeah, and those are really good points. And I'm just kind of thinking about one of the things I get excited about when I'm doing strategy calls. If someone's like, hey, I've got so much debt, I can't do this infinite banking thing. we look at all of the puzzle pieces they have, and maybe they've got a $5,000 credit card. They could be making a minimum payment of 100, but they're paying $500 a month towards that card. Well, all of a sudden, we start to have these conversations about, is there a better way to take that excess, run it through a policy, and then throw it at the debt? So it's just a matter of understanding what are all the pieces you have, what your cash flow look like, what are your assets, where's your money going? That's the real question. Where's your money going? It comes in the door, and then where does it go? But what else? What else is out there? I need $100,000. What else do we hear?
It's too good to be true. That's I hear that one a lot. And the way I always answer that or respond to that one is like, well, let's say you have 100 people that want to get into the new club that is in town. Everybody wants to get in. It's going to be great. It's going to be awesome. But only 5 people out of those 100 are going to be able to get in. So is that club that is supposedly too good to be true? Is it too good to be true for the other 95? And so why I say that is with infinite banking, we believe what 5 to 10% of the population can qualify to do this. It's not going to be a fit for everybody. So it's a privilege to be able to do infinite banking, in my opinion. It's not too good to be true because it's not for everybody. Not everybody can do it. You have to be financially literate. You have to have some financial responsibility. You have to have, the health to be able to get qualified. So that's one I hear that one a lot.
I love that, Fal. It's another one is I can't afford this. It costs too much, right? It costs too much. I hear that all the time. And as soon as you hear it come out of someone's mouth, how much is it going to cost? It's because of what our expectations are, right? We're used to being last in line for our money. So when we start thinking on a month-to-month scale with everything, how much can I afford in this month? We lose sight of long-term thinking. We lose sight of what our money is actually doing and how much things are costing us. And so it's just a simple reframe. Like that's a conversation where their words are telling me their world already. It costs too much. It's almost like when you flip it, when you go to the other side, when you understand it, you start asking, how much can I put in? Can I put more in? How do I get all my paycheck in? Like that's the switch when someone really starts to get it. But I hear it a lot. I can't afford this. It costs too much. Or Chris says it's 10 times my age. And I'm just like, okay, what are we trying to solve? Like that's a great guideline, but it doesn't give me enough information on how we can solve your problem today and go all the way out to your long-term vision and build you a ramp to get there.
How much money am I going to make? This is not an investment.
Hey, Joe, I was going to say the exact same thing right there. People look at this like, hey, this is an investment. This is where I'm going to put my money. What's it going to grow at? Oh, I could invest in my IRA in the index and it's going to grow more. And it's like, go ahead. Thank you for saying that. Keep going.
Absolutely. This is a system. This is the and product. You're taking your money, you're running it through, merely running it through the policy and still using that money to do whatever you want next, to put into that investment, to put into that Roth or whatever investment the Snaggy just said. It's an and vehicle. It's a run through. So it's nothing to do with the numbers. How much am I going to make? Oh, what's the interest? Oh, how much do I have to pay? It's not the numbers. It's the system.
Cool. Anything else?
Yeah, go ahead, Brian.
I was going to call out Donna's comment here in the chat because she was on the webinar yesterday, and she said the one she was asking about yesterday was an IUL. So IUL is an infinite banking water to me, but she put her question into Chat GPT because I mentioned something, and Chat GPT came back and said there are legal issues with IULs.
You don't say. Yeah, the regulators are all over them. There's all sorts of issues with IULs, and they're becoming more and more prevalent. You're going to see them, and the insurance companies know that there's all sorts of problems with them. We hear about it at the meetings we go to. IUL comes up, and they're just like, yeah, well, about those, and then there's big problems with private equity in the insurance industry as well. But you know what? They're going to keep selling them because they're high commission. They're very, very profitable for the insurance company, and well, until something serious happens, and that will come when the markets stop performing, then you will, just like anything else, when the tide goes out, you see who's swimming naked, and we're going to see a lot of naked people. That's either going to be a good or a bad.
Never heard that before. That is super strange. And another reason the insurance company stays profitable when it comes to an IUL, they actually control it. They can turn down the contract, right? They can turn down the upside. They can turn down the contribution. So if they're not profitable, guess what? It's definitely not going to work the way you were shown. So,
All right.
And there's a question, what is an IUL?
Oh, yeah.
can we find a kind of a better acronym? Anybody got something fun right off the top of their head? No.
Gross.
I'm trying to think what my shirt says. IUL.
I don't know, but I
Imag-
really like your shirt. Speaking of shirts, Chris.
Imaginary Unicorn Life.
Yeah.
There you go.
Indexed universal life. So it's just a whole life policy that is tied to the performance of the markets. So they're volatile.
It has rising costs of insurance as well, so you don't have steady costs of insurance. It's every year you get older, so does the cost of insurance.
Most people selling them give false promises and put way too much emphasis on a hypothetical return that more than likely will never, ever materialize.
Yeah, let me answer this question too, because this goes into what you just said, Chris, with the misconceptions. They asked right here, where's the money going to stay if it's through the BYOB infinite banking system? So a lot of people look at like, hey, we're giving you guys our money. Where are you guys storing our money? Like, how's this work? And you guys want to clarify what we do and the companies we work with real fast?
Yes, please. Yes, please. This is fun, Snaggy. Thank you for that. And Naugle, I was on a call yesterday with a guy up near you in near Buffalo, maybe a
I'm
little
sorry.
bit. Yeah. I mean, and he was fun. He was fun. He kept saying, I want that secret sauce. I see Chris's videos. There's secret. Where is the secret sauce? Hey, man, the secret sauce is we are helping people solve their problems through specially engineered whole life from a mutually owned company. You are never sending us money. I always tell everyone, I give them my address. No one sent me a check. I got honey. I got a hat, but no one sent money yet. So you guys are never sending money to anybody in BYOB. You're actually trying, hoping that one of these mutually owned companies that we all have policies with will approve you for a whole life insurance policy that's specially engineered for your privatized banking.
Dude, read Christopher Beatty's comment. Invested option undermines reality. How freaking good is that?
Oh, that's cool. That's cool.
Wow, I never heard that said. That was really well put. All right. Anything else we go before we move on to round two here?
Well, I mean, there's one I think Marie listed. It's near and dear to my heart, which is why not just buy term and invest the difference?
I know a guy who read a white paper on that. You ever hear about that?
Oh, yeah.
Yeah, I heard about that, but it's, well, I mean, why doesn't that work? Why is BYOB better than or different than buy term invest the difference?
Well, there's no guarantees that for one, there's no guarantees with buy term and invest the rest. Because term insurance is not a guaranteed death benefit. So you're cutting out a lot of the guaranteed generational wealth day one, which, I mean, one of the big aspects of infinite banking is generational wealth that is tax-free and guaranteed. So that's pretty much off the table. That's one thing right there.
They pay out less than 1% of term insurance. You wouldn't have received that term unless you were going to outlive it. Therefore, the actuaries will not give you a 30-year term and only a 20-year term if you're such an age, so that it will be number one profit on the line of the insurance company as just money.
Love it, Joe. So you're saying that you have a 98 to 99% chance to outlive the term that's on your life.
Absolutely.
That's interesting.
What's the percentage of whole life that pays out?
As long as premiums are paid, it's 100%.
You know anybody that lives forever?
Bigfoot.
Duncan McLeod.
Yes, I got that dude's been around for a while. I mean, you see that Indians were shooting arrows at him.
And oh my God, I just forgot. Never mind.
Well, the invest the rest.
I got it. Well, wait a second. Don't believe anything we're saying. Just don't believe anything we're saying, right? Like, listen to us, but go think for yourself. Go look the stuff up. Go down the rabbit hole yourself. That's how we all ended up here. I wasn't like, oh, that's the coolest thing ever. Wow. And just believed everything. No, I went and tried to poke holes in that sucker. I went and looked for stuff. I went and tried to find out why is it too good to be true? And then I couldn't disprove it. And now I'm here. And now this is all I do. So don't believe us.
What's 16 months and $150,000? That was my aha moment.
I don't even know. I don't even know what that means. I'm sure you'll tell us, but I don't know what that means.
It
It's a
took me
Cadillac story.
my Cadillac story. It took me 16 months to actually get the policy.
Yeah, I just
And,
remember your movements, man. I don't know what you're talking about. You know, sometimes you go like this and sometimes you go like this.
then I went and paid cash for a vehicle, and while I was doing it, realized that if I were to run the money through the policy first, well, then I would always be getting interest and dividends on that money until I stopped breathing. And that's when I called Chris the next day and got my first policy.
That's all right. Tess said she intentionally came to this wealth webinar and this campfire to prove that Chris Naugle was a scam. And so now she's still around.
That's incredible. We
Yeah.
have to unpack that story with Tess sometime because I've never heard that or even seen that side of Tess. So that'd be pretty cool.
Absolutely. Absolutely. And somebody else in the comments, anonymous, had asked, what do you think about Bitcoin life insurance? And I had been hearing about this. So I went on, there's this one website, like they're literally now, using a token and using it with whole life. It's very new. The biggest concern that I'll put out there about this, because I have been hearing about this. So I wouldn't say it's common, but I would say there's a fair amount of warning that needs to go in with this. The Bitcoin life insurance, the whole life using Bitcoin as the currency or the funding mechanism. You got to remember how volatile Bitcoin is. Okay, the US dollar moves, right? The value of the US dollar changes, but it's a very small range that it changes within. Bitcoin can swing, my God, it can swing 20% in a day. So like until there's some stability there, and I've been seeing more and more stability in it, but until there's ultimate stability, it's just a very speculative play with a long-term vehicle. So whole life in its nature is a long-term planning. Okay, you're not planning for tomorrow or the next day. It's long-term. When you talk Bitcoin, it just doesn't have a long track history. So you're matching a new thing with an old thing, and hey, listen, maybe it'll work, but that's my take on it. I don't really know too much more to say about it. I mean, it's Bitcoin's not going anywhere, and I just don't know how to pair that up with whole life in a way that doesn't provide more risk than there is return for doing that. That's my overall opinion.
Unless you use it as an and strategy, and maybe not Bitcoin insurance, but maybe you're taking some of those funds, you're starting a whole life policy, you're taking a loan, putting it back in Bitcoin and trying to make a spread on it then.
Yeah, I think there's just probably a lot of research we'd have to do and kind of talk to some of the actuaries, at the insurance companies to kind of wrap our head around that. But I'm sure that'll be coming up more and more. So stay tuned on that. But there's a lot more stuff that is going to be far more exciting, a lot sexier than Bitcoin whole life. So let's move on to round two.
Hey,
I love this one. This is one of my favorites. Did you have something, Stephen?
No. I thought you were talking about me. Talking about like
I got one quick thing.
Yeah, go ahead.
I just learned something. Somebody asked, what does underwriting mean? So I Googled it. And where did the term come from? From the 17th century, when they would do sea voyages, people would say, hey, I want to be in on this deal and take on some of the financial risk of that sea voyage. So they would write their name under the name of the event. So they were underwriting. They were underwriting those deals. So anyway, it's kind of cool where that came from, but they were willing to take on some of the financial risk of the sea voyage. They put their name underneath the list, and that's where underwriting came from.
That is super cool. Thank you, Craig. That's probably gonna be the highlight of my day right there. That's it.
Yeah. Never knew. So learned something. But anyway, we can continue on to round two.
All right, round two. I love this one. It's use it or lose momentum. And I think there's a lot that can be said about that. And I think a lot of people will take something away from this. So here's the question. What happens when people just sit on their policy? What's the right first or next move? So, a lot of people that start, like they get the first idea, I got to change where my money goes first so I can be in control and earn a better interest rate in the tax-free environment, protected against judgments and liens, and I get a death benefit for my legacy. So they get all that. They put the money in the policy, but then they kind of freeze up. It's like a deer in headlights. They don't know what the next move is. So again, what happens when people just sit on their policy?
You grow an opportunity fund. I mean, number one, you're storing your money someplace better. So you're not going to get wealthy doing infinite banking or privatized banking or family banking or whatever you're calling your bank, but you're building up an opportunity fund. You're not going to make a spread like the banks. So you're not going to necessarily get financially ahead, but you will be more secure. You'll have more control and you have more guarantees. So I don't see that as, I think a lot of people use this as, like Hannah would say, a glorified savings account. I don't see anything wrong with it. It's missing opportunities, but if you're going to store your money somewhere, just look where the banks are storing their money. They have over $225 billion of this specially engineered stuff, and they've quadrupled the amount they bought since 2012. There's got to be a reason for that. What do you guys think?
I mean, I've had clients that do that over the years, that they have an emergency fund that they're just putting money into every month, and they realize, well, wait a second, I can just take that emergency fund and dump it in, and then take the same amount of putting into it and put it into the premium, and my cash flow has not changed, but now I've got privatized. They think their money's safer. I've got a tax-free guaranteed death benefit, and it's still liquid to use it for an emergency. So they're like, well, wait, it makes so much sense, but they don't really have a need for it really outside the emergency fund, so they don't want to touch it. So and then another client did the exact same thing, but it started growing. This is years down the road, so much that it was larger than their emergency fund needed to be. So now they realize, well, wait a second, so I can call it, $30,000 liquid, and then use the rest of it for investing, building wealth, buying a car, paying for college. And so actually for them, it was the best of both worlds.
Let me add to this. I think one of the uses I like, and I know we always talk about, you start the policy, you put the money into it, and you immediately take the money out in the first 30 days. But there's a big but there, and I got to start saying but only if that money can go work for you at a higher interest rate than what it costs you for the capital. So if it costs you 5 or 6% from the insurance company, you better be able to make more than 5 or 6%, and then also risk adjusted. Make sure that the risk doesn't outweigh the return you're getting for it. But here's something that I think fits with this is, people that just sit on their policies. We work with a lot of family members, a lot of grandparents, and a lot of parents that take policies out on their kids. I know I've got 2 policies out on Vivi now, and there'll be a lot more. And I know a bunch of you all have policies on your children. And I will tell you this, like the policy I took out on Vivi, and if any of you ever seen the YouTube video, Vivi Lucky Jeans, that policy, we don't even use that policy. We leave that policy sit for like 17 years and just accumulate and just build. So like there is absolutely nothing wrong with that. But you see, here's the beauty. That money is sitting in building, and it builds quite phenomenally. And if any of you want to see that, maybe I'll show it at the end. But think of it this way. At any time, if I needed something, or Vivi wanted to buy something, like maybe she wants a 4-wheeler or a dirt bike, maybe she wants to buy something that would require financing, we can then start teaching her at a young age how to be her own bank and be like, sweetie, we set this private banking system up for you when you were 6 months old. I know you want to buy this new mini bike, and if you want, we could take the money out, but you're going to have to do chores around the house. You're going to have to do this. You're going to have to do that. You're going to have to make some money to repay this loan with interest. So you can't take the money out unless you repay with interest. And also, we got to figure out how much interest you want to repay to yourself. So you start teaching them. Think about that at 7, 8, 9, 10, 11 years old. Like, how valuable would that be to teach your kids? Let me go one step further. Grandparents. Listen, like, I've been doing this 22 years. So all I can tell you is I've worked with a lot of grandparents who it was just second nature. It was like a mandatory thing that the grandparents took policies out, always whole life. Sometimes Gerber, like when Gerber came around, they would take policies out on their grandkids. Every one of them. It was a gift. It was like a birthday present. Do you know that I've seen a ton of those old policies, those old whole life policies that grandparents took out, and now these kids they're adults now. This policy's been around 30, 40 years. These things have tons of cash value, and they're growing substantially. Even if it's a super small policy, a lot of those policies, premiums were like $120 a year. So like now these policies, they got a couple grand in them, which doesn't seem like a lot by today's standards. But when you run the money year over year and you say, okay, that $2,200 in cash value grew to $2,360, you figure that gain, and then you figure that there's only $120 being put in that. But you know what the return on investment is? Massive, massive. So like any grandparents, All grandparents should be taking policies out on the grandkids. All parents should be taking policies out on the kids. And you know what? To make it even better, do the specially designed and engineered ones like we're talking about. So sorry, I stole the show there for a little bit. But again, what happens when people just sit on their policies? My answer is nothing. Like you said, it's an emergency fund. It's an opportunity fund. It's there when you need it. You are in control of it.
So you're saying, Chris, that, change will happen, events will happen. Like, how many people listening have ever had their air conditioning in their house or car go unexpectedly? How many of you had a transmission blow? How many of you had a doctor bill that was unexpected? Or, when you have money, do people find you that want you to put your money into something? Do they have, hey, I got an opportunity for you? Either way, these things are going to happen. So the question is, do you want to be prepared, or you want to just hope that it's going to work out? Right? Like that's kind of the mindset we're looking to shift. Let's help people. Like, here, I've solved everything. We can just stop the show right now. This is all we have to do. We've got Earl Nightingale's 7 laws of wealth. If we all followed those 7 laws and followed Nelson's 5 principles, put those 2 together, everyone knows what to do. All the directions are there. And it includes whole life, because that's the number 3 law of wealth by Earl Nightingale. Don't interrupt the compounding interest. It is the 8th wonder of the world. We're paying ourselves first. We're creating a buffer. We're building and building to the point where we're tithing from power and not from struggle. And now we're thinking long term. We're thinking generationally. Just think about this. Everything's solved. Are you guys excited or what? All the questions we answer, we got it all solved. Just two different things.
Well, if it's all solved, then Stephen, hey, listen, there's going to be a bunch of people that want to book calls here to set up policies on their grandkids and on their kids and on themselves. So you want to put the link up there? So if anyone wants to book a call, they can do that.
Yeah,
but I don't think we're
kind
done.
of thinking about this conversation. We've been kind of stuck in the savings area, but I was thinking about something Robert Kiyosaki says, and I've always kind of struggled with it because he says, savers are losers. I get what he's saying. I get his intentions of what he's saying is if you just put your money in a savings account, inflation eats it away, yada, yada, yada. But in the context of building out a strong foundation, if you don't have money for when, like Jason said, the air conditioner breaks or the medical bills come, if you don't have that emergency fund or those funds to be able to keep your machine running when they happen, that's like step 1. We got to get that solved. But let's move on to what else. So Joe, you've got money in your policies. Does it sit there? What does it do? I mean, let's talk about some other things that we might be doing with our cash value.
So there's different systems when we start this, right? So somebody starting off is new. So they're going to take their money and they're going to put it into the policy. They're going to start building the policy. They're going to squirrel it up. They're going to get it to a level to where they can pay off that credit card or do a dump to take that out right away. They're going to get to a level. So there's different levels of what you do in your policy. In the beginning, it's getting to that first level that you want to do. After you are debt free and you've done the most important thing is investing in yourself, now you can go to the next level and start investing to make more cash flow. So in that level, that's when all the money comes into my policy. And as soon as I hit that little button, as soon as it becomes cash value, comes right out. I keep no money in my policy as cash value while I'm growing. So until I take that money and put it into the investments to get my cash flow up. Now the next level after that is how much money do I want to have out? Do I want to have 100,000? Do I want to get up to 1 million? How much money do I want to have out before I start squirreling away again and just having that cash flow come in to fill up the policies, to fill up the HELOC, to do that. So, I mean, that's all done on a personal preference of how their money moves and how much is coming in. Obviously, somebody who's making $1,000 a month is going to have a lot less than somebody making $10,000 a month. So it comes to personal preference with that though. But as soon as it comes through, I have no cash value in my policies. It goes out into an investment. That investment comes in. Once the money comes into my house, that's where I put it into my HELOC, because I utilize my HELOC as the one pot system with the IBC as just the run through.
So one of the things I want to just rewind, because I want to make sure everybody got this. You said we should be paying our debts off before we go to investing. Let's pay our debts off before we go to investing. Now, what a lot of people want to do is go right to investing when they have debts.
So when somebody is paying 28% in a credit card and they have a few $1,000s that they want to put in to make 12%, how does that make sense?
Yeah.
Why would you invest in something at 12% when you're paying 28% on a credit card? You have to invest in yourself first. That is the most important thing to do, and get yourself out of debt. Get yourself getting cash flow, positive cash flow, and now you can go to the next level. Now you can look at that, making that 12% or 15% with that investment. But until you do that, you're going to be like Bugs Bunny running backwards.
Digging a hole.
Mm.
Gotta put down
All
the
right.
shovel.
Let's hit round 3. The shift that changes everything. This is a big one, guys. So this is going to take time, but what's a mindset shift you've seen that has unlocked progress for a client or for yourself?
Paying yourself first. Being in control.
Controls, and I don't say is a big one right there. Like I always say in my presentation, control of money, control of time, control of mindset. Control those 3 things, you can control your life. You know, for me, one of my biggest shifts that got me away from the corporate America was when I was going to go on vacation to Mexico. We'd had a plan for 6 months, had to fill out that little slip, the vacation request form, and give it to my boss of the company. And then a week before, they told me, we got a big project, you got to go run it. Can't go on vacation. And I was like, well, I've already paid for everything. I'm going to go on the vacation. I can't, it's canceled for my family. And they said, okay, go for it. Might not want to come back. And I realized at that point in time, I had to control my time. They controlled it, and they controlled the money. So that was a huge shift for me right there. Huge shift.
I think for me, it's about even early on, many years is all about the math for me. It's like, how does this work? And I struggled for almost a year on the short-term versus long-term understanding of this whole program, because like, well, I can do this right now with this money, and I could be way better off if I did this now. But when you start expanding the horizon, thinking, well, time's going to pass. 5 years is going to go by, and then 7 years is going to go by, and 10 years is going to go by. And now that my oldest policy is 16 years old this year, I'm like, damn, I wish I had about 10 more of those. But so getting past that short-term mindset where I can do something better right now, long-term, if you do what we're talking about, you're going to be in a way better position.
If you're able to take out more money than what you put into it, did it cost you anything, Craig?
No. I mean,
Yeah, said differently, if you knew every dollar, right? If you knew every dollar that you put into a system came back tax-free at passive income time, would you hesitate to put more in?
If you're able to take out more than what you put in, would it cost you anything? Then why
Cost
wouldn't you do it?
Cost you nothing. Just time. It's time. It's time what people are afraid of. There's time. It's like, what do we say on the one AMA? We said 2 years, 2 years of patience for a lifetime of profit. I think that was the quote we came up with, something like that. So, yeah.
In answer to Chris's question for this round, legacy. Legacy is a big part, because everybody who knows me, there's only one reason why I breathe air. So, and that's Ariana. So when I finally do leave, she will have substantial with my death benefit. So by me running my money through a specially designed policy, and still being able to invest, and still be able to doing cash flow, and still having that protection for whenever that day is, that is what makes this whole system come together.
I love that, Joe. And for me, I don't know who we have here that are Star Wars nerds. Fouts might do this because I don't think he is, but it is like, remember the scene when Luke goes into the cave and he starts, confronting his demons. And what happens is, not to spoil this for anyone who hasn't seen the movie, but he sees himself. Like he is his obstacle. And for me, the obstacle was money. I just avoided it. I avoided cooler talk. I avoided investment talk. I thought I could just do what I saw my parents doing, showing up first, leaving last, working hard, adding value, being humble, and life would be okay. And then I would just go do what I want outside of work. And I'm getting goosebumps telling this because I had so much fear around money and I didn't even know it. And when I realized it, and when I decided I wanted to control it and understand it, like other things I had done well, whether it was, being a dad or being an athlete or being an employee, whatever it was that I put my mind to, I knew I could achieve it. And I didn't know why money was so scary. And mostly what I learned is because lots of people like to use really big words, lots of jargon, and they like to confuse everybody. And I found that if you can't make this simple, you don't understand it. And so, like, when I read Nelson's book and I thought, this can't be fucking true. If this is true, every American would do this. And I got mad and I got really mad. I read the book again. And don't be impressed, 91 pages. I joke about that all the time. But I called my buddy, and thank God we weren't face to face because he's giant. He's like 6'5". Like he towers over me. And I cussed him out. I was like, Brian, what the bleep? Like, why didn't you tell me about this? And he goes, Sip, you weren't ready. But the changes since I became ready, I'm here. I'm talking about it. I'm spreading the message. And I had an aha moment yesterday when my friend, who I've been telling him, take a policy loan, pay off your Tesla. And then he tells me, but I've done the math, Jason. I actually will lose interest. I'm like, no way. You're paying 5% to Tesla. You're losing that interest. There's no way. You just don't know how to do math. I ran the math yesterday when I finally got his policy loan information and I got the information back from him. He was right. His policy loan from Northwest Mutual, because they don't really support infinite banking, it's a direct recognition company. He would have actually done better financing through a bank. So what I learned yesterday is, as much as I love this, as much as I want to tell everyone they should be doing this, it's not always the answer for everybody. It's not the only answer. There's a lot of answers. It just matters, how much do you want to have control, certainty, and guarantees in your life? Do you take on enough risk already with everything you do? Or do you want to have something that you actually control and you have the keys and you have the team to teach you?
Well, you said it in a nutshell. It was direct. If it was non-direct, the interest or the dividends that would come back in would negate the interest paid out, therefore creating a negative, which would have definitely been a positive to run it through the policy instead of the bank.
And then
Well,
Joe, this guy's a beast. This guy, he's my buddy in Taekwondo, and he's a couple ahead of me, and he's a lot bigger than me, and he hits like a truck. So I was kind of glad that he was like going to Alaska yesterday, and like I could apologize, via text for being an a-hole for the last just several months, just telling him like, you just don't know how to do math, man. Let me get a calculator and show you. Tell me your numbers. And I was wrong.
But the math isn't done though. That's the thing I would do from that point. Even with his Northwestern policy, if there's more interest he would be paying with the policy than he would with the insurance company. If he pays the car loan off through cash, the opportunity cost needs to be factored in, because how much money are you going to make on that money you just sent to the dealer? For the rest of your life, zero is the number.
Mm-hmm.
If we take that math and we put it over to the policy and say, I'm going to run that into my premium,
Yep.
It's a different ballgame. So there's opportunity cost too. And so you're right, Jason, he didn't know how to do math because he missed that whole piece of it.
Right.
Well, thank God I know someone who knows how to do that, because I don't know how to do that. Like that's some beyond me, because I thought about that. Like, I know he doesn't get direct recognition. So while the policy's out, while he's repaying it, he's not getting full recognition. And I've heard Craig say that's just another variable. And I was like, I don't know what to tell him now, except I'm sorry. So
we have a solution. We have a solution for that coming, Chris, don't we?
Oh yes, the solution shall be the answer.
My favorite thing to do on a phone call when I'm talking with somebody about mindset is Chris's car video. You want to buy a car that's $25,000. You have $25,000 in the account making you 4% interest, or you can sign and drive right off the lot for 6%. What are you gonna do? And I say, do you think that 4 is less than 6? How do you do this? And then they say, which one would you do? Oh, I would go and just pay cash so I don't have to worry about it. I said, well, here's your sign because you just lost money. Because your brain sees 4 and 6. They don't see the interest going up. They don't see the interest variable going down. And that is why you're doing the things that you're doing and not the things that we're doing. So that's the whole start of the mindset.
Just listening to all this, it takes me back to like when I very first heard about this. So I was a financial advisor. Me and my wife were doing some real estate stuff. I was making really good money. I think as an advisor, I was making close to $300,000 a year. So I had money in a 401k because we had one through the firm. I had money in investments. I had money in lots of places. But also over on the other side of the coin, the other side of the balance sheet, I had lots of debt. And I remember I always felt good because I had money, right? I had money in the bank. And then, but I always felt every month strapped because I had all these debts that I had to make payments on. And I don't know why it's so logical, right? But it's so counterintuitive to what we're taught. For all of you listening to that, like if I got money in the bank and I got a bunch of debts and the debts are stressing me and the money's not earning much, wouldn't it just make sense to take the money out of the bank and pay the debts down? I couldn't connect the dots. When I initially saw the 90-minute video, and folks, we'll put the 90-minute video up in the chat along with a way for you to book a call to talk about this. But when I watched that video, my mindset was completely shifted because what I then saw, I saw that number one, somebody had mentioned it earlier. I think Sharon had said money's a tool. I stopped looking. Now, the reason I had a bunch of money in cash accounts and things like that is because of my comfort. It's like comfort food, right? It was like my comfort. Made me feel like I was accomplished. Made me feel like, oh, I got money over here. I can invest it if I need. I can invest in that. If Apple comes down in stock, I can put money in that. I had that, but I was literally on paper broke, which is why I had a hard time getting like loans for some of the real estate I wanted. Because like on paper, the bank was underwriting me properly. But for me, I was just attached to money. Money wasn't a tool to me. Money was just an attachment, something that I had, it was a scarcity mindset on. So when the video, here's what it did for me. It showed me for the first time how stupid I was, that I didn't connect the dots to just take the money from my savings over here and then pay off the debts, obviously through the policy, but you know, this is just the mental way I looked at it. Pay off the debts. And then don't stop there because that's where everybody stops. Take the money, pay the debts off, you feel good. Then Joe, what happens? You're back in debt again, right?
Yep.
So
same thing.
You gotta add another step. And this is the most important thing, folks. And this is where my mind shifted. And this is why it all changed right then and there. Whatever I was paying to the debt or the debts that I just paid off, I would then, right then and there, when I paid it off, pay that exact amount to myself. Mm-hmm. So if I took money from my savings and I paid off a Visa, and that Visa was $200 a month, I would then set up that exact same $200 a month payment, but I would pay it back to Chris Naugle, not Visa. And every month, $200 went back into the account where it came from. Now, all of a sudden, I didn't feel like that money was gone. I was watching that money coming back. But see, now I also understood something else. I was now making whatever the equivalent return was. Because if I was paying Visa 20%, now I'm paying myself 20%. You look at it as, no, you're paying yourself $200. No, no, no. I'm paying myself 20%. The second I converted that in my mind, I'm like, well, I'm going to pay everything off. I'm not going to let any debts be out there. I'm going to always pay them back to myself. But then when you run it through the policy, your policy never stops earning interest. So when I do it from a bank account and I pay off a debt with a bank account, that money stops working the second I pay the credit card off. Then I start slowly building it back up. But when I do it from the policy, literally, like I have no stoppage, I have no interruption of that compounding, but yet I accomplish the same exact goal. This is the part, the mindset thing that I just can't understand why people don't understand. Even today, we've talked about several people that like, they understood the top part, right? Oh yeah, I put my money in this policy because it pays me a better interest rate, tax-free in a tax-free environment. I pay off debts or I do whatever with it. I got it. You don't got it because you haven't finished it. You are literally stealing from your bank if you stop there. And so many people stop there. because they're like, I accomplished my goal. I paid my debt off and I still got money in the policy growing. Yeah, but you now have a policy loan and now you're just going to go out there and you're going to rack the debts back up and you're going to blow the money. Listen, folks, I'll tell you this. Since that day, and that day was well over 10 years ago, do you realize there has not been 1 month, not 1 month in my life that I have carried a credit card balance? Not one. I use the hell out of credit cards. Shit, we buy everything on credit card points, folks. Like, I know, like, listen, that's the big thing. Oh, I get points. Oh, I fly free. I get this. Shoot, I got hundreds of thousands of points on Delta. Shauna buys all of our toilet paper, our soaps, everything on points. My wife buys, I don't know, dolphin pool cleaners with points. It's just like, I use the hell out of credit cards, but every month, those credit card companies get fuck all nothing from me because I'm in control and I'm keeping all the money. Like, listen, I don't mean to go long on this. That was my biggest mindset shift of my life. And it was just connecting the dots. That was it. It was just that one simple shift that I got to pay myself back the same amount I pay them. I do that for cars now. And when I do an investment, like I always figure out like what money is that investment going to make that I can put back into the policy, my banking system. My mindset is so far evolved for this whole thing. I don't even call it a policy anymore. I just have to for all of you because you're at that early stage. For me, it's my banking system and that's it. So how do you buy these cars? My private banking system. And then that's it. And then if you ask me, well, what is your private banking system? Then I'll explain it. But if you don't ask me, I'm not going to even talk to you about it. You're just going to wonder how Chris has all these Porsches and he says he gets all this money back for every car he buys, drive, and own. And if that's where you want to stop it, good for you. You probably live in Buffalo. Anyway.
I'm so happy to know that you didn't steal them. I was worried for a while. They started piling up. There's a red one and a black one. And I was like, where are these all coming from? So now you just told us. That's cool.
If I ever get like the urge to feel like I'm living life on the edge, I can be like, well, I stole that car because I got all the money back for it. So I did.
It's true. It's true. You should say that. We create a video right there.
How'd you get that car? Stole it.
Stole it.
Cost me nothing. I actually made money on that car because I stole that son of a bitch.
And then I sold it for more. I made double money, infinite money on that car.
All right, so we got a bunch of people asking about velocity banking and using HELOCs with IBC and that entire process. Do we want to maybe get into that a little bit? Because I know that's
we got
I know we're going to do a whole segment on that next month, but maybe a little preview for that.
Yeah, HELOC Joe here. Yeah, Joe. And you got Craig here for the mathematics. You got HELOC Joe for the ultimate conceptual, but then the math, we'll leave that up to Craig. So
I do want to say though, Chris, real fast, starting next week, is that right? Starting next week? Or is it
we got a whole series, 4 weeks, folks, of wealth webinars, and we're going to be literally starting start to finish with this system that you're going to hear Joe talk about, the all-in-one system, the one pot system, whatever you want to call it, but basically using a HELOC or a first lien HELOC to basically run your entire life from in the benefits of it. Because too many people are house rich and cash poor, and it's sad because they don't have to be. Right, Joe?
That's correct. Yep. You have money stuck in the 2x4s. Why aren't you putting it to work? What's it doing for you? Is your house an asset or a liability? Your house is a liability. I don't care if it's paid off. I don't care if it's day one. Unless your house is paying you to live in it, it is not an asset. There's only one way to make it an asset, and that's to utilize the equity, put it into work, and make cash flow and have your house pay for you to live in it. So that's that in a nutshell with the equity. Utilizing the equity, I do by leverage. So I'm leveraging the money from the bank, and I'm creating arbitrage. So I will gladly borrow at 8% to make 12%, 15%. And then when I run it through the policy as a run through, that just A, hedges my money, B, creates legacy, C, I can still use it because why? This policy is an and asset. I've been utilizing HELOCs and velocity banking and leverage and arbitrage for 15, going on 16 years now. And that just creates a one-pot system. So when the money comes into the house, let's say you have $10,000 a month coming into the house, and $5,000 leaves it in bills. What's left? $5,000. Well, you have a mortgage. Why don't you just take that $5,000 and put it down on the mortgage? Because you might need that money. So why don't we use a HELOC, which is a revolving line of credit? That $10,000 comes into the HELOC, $5,000 goes out of the HELOC. What did you do that month? Put $5,000 on the principal of that line. And you still have access to it. A, you're in control of the HELOC. B, you're not in control of the mortgage. You're paying simple interest with the HELOC. You're paying amortization with the mortgage. Go ahead, Craig.
I was just going to say, before we go too much deeper in it, and I'm just thinking about everyone on today, they may not know that there's different kind of HELOCs. And so maybe explain, next month is all about first lien HELOCs, the all-in-one. So maybe just explain a little bit about the variations of HELOCs that are out there and why we use the one we do.
So A, you have to qualify for a HELOC. 45% debt to income ratio is opposed to your income. The amount of money that we can get as a line on your house could be 80, 85, 90%. Or me and Chris, well, I got 100,000. I don't know. I got 100% of my house. I don't know if they didn't give Chris 100.
No, they didn't, Joe. Thanks for rubbing it in.
Sorry, I just wanted to say that.
That's all right. I just found out Devin was getting a lower interest rate on his CB line of credit than I was, and I think I referred him to the company. But we fixed that today. So hey, listen, I'm used to getting kicked in the nuts here.
That's one of those swimming pool conversations.
So anyhow, there are HELOCs that go up to 100% house value, and yes, I have one. So now every single solitary penny of my equity is in motion. HELOCs. Can we get a second lien and keep the mortgage in place and just utilize the leftover equity that we have? Maybe we've only been in the house maybe 5 years. So there's just a little bit that we can use. Can we still utilize the system? Of course we can. What do you think I did back in 2010? That's how I used the system. But because I use the system, and I've been doing this for 15 years, I can jump you to the next ladder because I know the next ladder. If you get this system, then you're going to go to here, and then you're going to try to get it all in one anyway. So as much as we possibly can, we could utilize, what your income is and how to do that. But second liens are just utilizing the equity and still having the mortgage, or a first lien would get you up to 90%, pay off the mortgage, and now you have a revolving line of credit with your mortgage, the cars, the credit cards, all living inside of that HELOC. And now you could do that system, the one pot system, all the money that comes into the house, the money that spends out, the leftover pays to the principal.
And Joe, I'm going to post the YouTube video, the podcast I just did with Harrison George from CMG Lending, and they do the all-in-one. This video is really good. It literally takes what Joe just said and brings it to like a 5th grade level. So if any of you are interested in what Joe is just kind of mentioning and looking at like how does that work, there's the podcast. And we're also doing a 4-week series starting next week all about this. So it's a lot to unpack, in just like 5-10 minutes. But once you see, a start to finish solution, like literally, like it took me, Joe, I'll be the first to say, when you first started talking about the one pot system, I'm like, yeah. And you were drawing it. I started to understand it when you were drawing it, but when you would just explain it to me like that, my eyes rolled back in my head. Did anyone else kind of have any of that kind of your eyes roll back a little bit? It's not
way
hard,
back.
It's not a hard concept. It's not.
It's simple.
But it's simple. But you've been doing it now for what, 15 years?
Years, yeah.
Yeah. So it's simple to you, just like IBC is simple for all of us. But for somebody that's here for the first time hearing this, Their eyes are rolling back in their head, probably even with the IBC stuff. Even though IBC is as simple as changing one thing and adding one step, you've got to follow the rules. And a lot of people hear half of it or start halfway or, you know, here's the thing I always have said, and I've just always been a visual person. A picture is worth 1,000 words. And seeing it drawn out, seeing a video or like a diagram of something helps you explain and really articulate it. All Joe's talking about is just replace your checking account where you pay your bills with this all-in-one one-pot system. Everything goes into it because right now all your income goes into your checking account. So that isn't very hard for any of you to understand. Money's going to this checking account. Now it's going to go into this checking account. Everybody understand that? Okay. Everything else is very simple. That's the hardest part. That's literally the hardest part of the whole thing.
Yeah.
You pay your bills from that checking account. You just pay them all. And then, you know, when you get money back from paying something off, it all comes back to that one place. It's one central place. Everything starts there and everything comes back there. Does it really matter what that thing is? If it will pay you more money, if you will earn a lot, if you will pay your debts off faster and your money will earn for you, does it even matter what that thing is?
Exactly.
It's the exact same thing you're doing now. It's just a different vehicle for a different purpose. And it will absolutely pay your debts off. It will absolutely pay your house off way faster. And you will be in a much better financial place just using that. And then if you pair that up, because that's velocity banking and all in one, okay, that's kind of a combo. You pair that up with the infinite banking concept, and now it's just pretty much an unstoppable foundational. Notice how I said foundational place. Because here's another thing. This is another mistake, and I think we could go hours on this one. How many people do you talk to, guys, that literally when you're talking to them, like they come back and like, well, my brother-in-law or my advisor said I'd make more money putting it in the S&P, or I'd make more money buying Bitcoin, or I'd make more money putting it in gold than that stupid whole life. Right when you hear that, right? Don't you get pissed? Punch that brother-in-law or punch that advisor. And I was told by compliance I'm not allowed to talk about punching people in the face. So we're just going to kind of just imagine that. But it's very frustrating because it has nothing to do with whether that makes more than this. Because all it has to do is where the money starts. And then it's going to go to whatever your brother-in-law tells you. Oh, put it into this Bitcoin. Oh, hey, Doge or what was that coin? That dog coin, whatever. Was that Doge coin? Doge, anyway, the Doge coin, or put it in this or put it in that. Great, do all those things if you want, but put the money through the policy first. And now all your money that starts in the policy earns interest and dividends, uninterrupted compounding for the rest of your life. And then you still invest in those, and whatever they make or lose, you know, that you still got that. You could get mad at your brother-in-law if he gives you a bad investment. At least your money's still earning for you. That's the simplest foundational thing you need to understand. It's not this or that, it's this and that. Thanks.
And product. And
there's you kind of back on the HELOC conversation. A lot of people get stuck on, well, I'm at a 3.5%, you know, mortgage rate. Why would I refinance into this all-in-one at 7 or 8%? Doesn't make sense. And the only thing I'm going to say on that, because we'll talk about this in great detail next month, start looking at volumes of interest as opposed to looking at rates of interest.
Yeah.
Just look at it from that perspective, because the bankers are over here, ding-a-ling-a-ling-a-ling, look at this rate, ding-a-ling-a-ling-a-ling, but it's not the real volume of interest you're paying.
bankers don't even understand the difference between simple and amortization.
No, they don't.
They don't.
Here, let me just sum it up in one thing, because I know we got to get to these questions that Steven's going to read. I can see his eyes. He's like beaming us. Let me ask you all this. How many of you, and you can put this in the chat, how many of you just want an easy button? You just literally want to go into a computer program and hit a button and have it tell you exactly what to do and the most efficient mathematical thing. You don't need a calculator. You don't need to figure any of this out. You don't need to draw a picture. You hit a button and it comes with cute little sound effects. You guys want the easy button? Remember the staple button?
Yeah.
How many of you want the easy button? Okay. How many of you want an easy button for velocity banking too, right? You just want to hit a button and it just shows you and it does it. And you just print it off and you're like, hey, I'm not very smart, but this math looks pretty good. And you show it to your advisor and your dumbass brother-in-law and sister-in-law, and they can't argue with you anymore because it's like the math is right here, you dumb fuck. It's right there. Sorry about the swearing. I'm from New York. If you don't know, I have a license to swear. So no harm, no foul. Like, you want the easy button, don't you? Good. How many people just said they want the easy button? That's the world we live in. Everybody just wants a button. Like none of the folks on here want to spend an hour and a half listening to us draw diagrams and tell them how to do it. They just want to hit a button. That's it. Craig, do we got a button?
We have a button.
We got
And
a
we have
turbo boost button. How many of you used to play the dirt bike game where you had the turbo boost? How many of you always used the turbo boost until there was no more turbo boost? Then you got it again and you hit it again. You want the turbo boost, right? Okay. Stay tuned. Stay
It's
tuned.
coming. Velocity banking, infinite
First-
banking.
First of its kind.
Chris Durfree had an awesome statement that you can use from this day forth. Punch them in the belief system. There you go.
No,
You no longer have to punch them in the face. Just punch them in the belief system, bud.
All right. Well, let's go to the belief system that we're going to answer everybody's questions in the next 8 minutes here. So, Stephen, let's hit these questions in 8 minutes.
Yeah, sounds good. So we do get this question a lot. So I was saving this one to ask the group, but they were saying they have a friend that just got into an IUL recently, put 100,000 in and is doing $1,000 a month. He was told fees for the first 7 years, and they were alarming, to say the least. So,
You don't say.
any advice there for somebody that's in a similar situation?
I would start by booking a call.
Yeah.
And I'm going to put that link right there. Book a call. It's not probably a good scenario, but there are things you can do. Lots of things you can do. You literally could fight it if there was things the agent left out or materially omitted or didn't show that now you're noticing. You probably have a legal case. A letter to the insurance company might get you out of it. You might be within your free look period. Doubt it, but you might be. Then you could get out of it. It's a bit of a fight, but a legal letter to the insurance company with the material fact of why it was missold or misrepresented will typically allow you out of it. And that's about the only way out.
And what if they're not allowed out of it? What would be the next steps from there? Because I get that a lot. Like I talked to someone this week that was 6 years into an IUL, and the same advice I've given others. Like, hey, I'm number one, I'm not giving financial advice. I'm not telling you what you should do. I'm not saying you should exchange it. And you have to look at what the surrender is. You have to kind of think about what you want. Maybe you go down. This is how I answered it. Maybe you go down to the minimum and you pay it till you're past the surrender. Then you get what you can out of it. Maybe then you exchange it. Or maybe you just start another policy if you want to do banking so you can control it. Like, is there anything else you'd add to that?
I mean,
Here's the only good thing you got going right now is you got the market's been good, right? So the participation rates have been fairly, competitive in IUL. So what it is, it's a mathematical calculation. Craig has done many of these where we literally just have to run the math on the surrender charge versus where you're at and then figure out, all right, here's what I'll lose if I surrender it today. And then you got to say, okay, depending on how many years you've had it, here's how much money I've made and how much I could potentially lose. You just run the math. I mean, it's never usually going to be a very good scenario in an IUL. I recently had one that was a VUL, and it was probably the only time that I've ever seen one where I'm like, hey, surrender this now because the amount of money you've made in this, even though you're going to give up it was like $4 or $6 grand in surrender. I'm like, if the market shifts and the market goes down, you're going to lose $4 grand in like a week. You might as well just cut and loss, take the surrender charge and call it a win. But in an IUL, you don't have that.
All right. They were asking, is BOLI, which is bank-owned life insurance, the same thing as this? Can you utilize it like the FDIC on separate accounts?
So BOLI is just like this, but it's bank owned, hence BOLI, bank owned. So unless you own a bank or own a credit union, you can't buy a BOLI or credit union OLI, however they say that, CU OLI.
Like a koala bear.
Quali. Yeah, whatever.
Koala bear.
But how we design these policies is literally very, very similar to how a bank would design a BOLI policy. The only difference is BOLI policies are sometimes in the tens of millions or the millions. So therefore they have a little bit of negotiation. So there's products that are made just for banks, but they are whole life in nature.
Yeah, we just mimic what the banks do.
Yeah,
So that's
copy
where
the bank.
your own bank comes from. And then these last two were just back on the HELOC thing. Can you do HELOCs on rentals? And they said, so we can buy our next home on a HELOC.
Yeah, there's HELOCs and rentals.
And you should buy your next home using a first lien HELOC.
Absolutely.
I just refinanced my house with the first lien HELOC. The one that Joe mentioned that he got 5% more than I did, which love to know why that happened.
That's
Had a
all the
relationship
question.
with that credit union.
I'm
So
Mr. Helock.
you just met them and they give you 5% more. That's interesting. It's funny. Love it. All right, what do we got next?
Probably something to think about, Chris. Something's going on more than once.
You know, it's just you know, we're gonna have to do that imaginary punch into the what was it? Punch the
Belief system.
belief system. Yeah. But with that being said, folks, you know, this was just a fun thing. We really wanted to give tribute to, you know, like Hulkamania, and you know, we just thought, hey, let's do a mentor pile on and talk about all these different things that we hear about and see. And I can't believe how fast time goes by. Hopefully some of you got something out of it. If you didn't, book a call with us so we can kind of go deeper into it. And if all the questions about the HELOCs, the all-in-ones, and velocity banking, definitely join us next week. It'll be the first of a 4-week series we're doing all about that. And it's literally going to be called House Rich, Cash Poor. Let's change that. That's going to be the name of the series, House Rich, Cash Poor. Let's change that. And if anyone is interested in booking a call, I'll put it up right here. There's how you book a call, the link. And we'll be back this afternoon. Same crew, I think, for Ask Me Anything Happy Hour at 4:30. Stephen, anything you want to say to close this sucker out?
No, man. It's get the call schedule. We got a lot of cool stuff coming up. The Wealth Webinar Series. We're gonna do a 2-day advanced infinite banking training called Money School IBC Essentials. Put it on your calendars. We'll start emailing out the link to sign up for that. But that's gonna be September 12th and 13th. If you want to throw it on your calendars, if you'd like to meet us in person, we are doing an in-person private money club money tank event in Orlando, Florida, November 7th and 8th. So Chris, myself, Craig, I'm sure Joe, as long as you're not with your daughter, Jason, I know you'll be there. Brian, if you can fly across the country, but most of our team will be there as well as several other people, incredible speakers. So get that on your calendars, November 7th and 8th. If you'd like to come hang out in person, they're super valuable on how to use infinite banking and real estate investing, specifically in private money lending. Really cool stuff. But other than that, no, I appreciate everybody being here, and we look forward to seeing all of you moving forward every single week.
Love it. Well, hey, thanks everybody, and thanks to all the mentors for this pile on. It was a lot of fun. We'll see you all on the next one.